Today, let me talk about STI. STI stands for Straits Times Index, which is a representative index of Singapore stock market. Similar to S&P 500 by Standard & Poor's, which is based on stock performance of 500 large cap listed in US stock exchange, STI is index for top 30 large cap listed in Singapore Stock Exchange, which is SGX. I was mainly focusing on stock market index such as KOSPI or KOSDAQ listed in Korea, or S&P 500 or Nasdaq in US, or DAX in Germany. But I have never paid attention to STI so far, so today I have made up my mind to study all about STI. As I said, component of STI consists of 30 top companies of Singapore. This is of course based on the market cap of each company, and I have looked at all 30 companies referenced. This table shows the top 10 company, which represent over 68% of STI total weight. Out of the top 10 company, top 3 companies are DBS, OCBC, and UOB, which are major banking companies of Singapore, which represent around 36% of STI weight. It means banking companies play an absolute rule influence over STI index. I was wondering how Singapore's stock market has been performing over a long-term period, so I checked how much STI increased over 30 years. So April of 1990, which is 30 years ago from now, STI was 1,558 and now it's 2,630. Therefore, over 30 years, STI increased by 80%. Considering the remarkable economic development of Singapore, this increment seems pretty low. You can see there are several dips in the chart. One is in 1998 when economic crisis happened in Asia, and the other one is in 2002 during SARS, and the other one is in 2009 when subprime crisis arose from US, and the next one is happening at this moment due to coronavirus pandemic. Then I have benchmark 7 other popular index I thought it worth to benchmark and compare. This is Standard & Poor's 500 in US. Over 30 years, index is increased by 765%, which is 7 to 8 times. This is Nasdaq performance listed in the US as well, as you all know. Main stock of Nasdaq are FANG, which stand for Facebook, Amazon, Netflix, and Google. And we can add Tesla, Nvidia, Apple nowadays that also represent the Nasdaq index. These DAX represent German stock exchange. DAX shows horrible performance over the past few years. However, it shows 543% increase over the past 30 years anyway. This is the Nikkei index of Japan. As we are talking about Japan, with no doubt, it even decreased by 39% over the past 30 years. This is mainly due to the extreme bubble economy Japan had in 1980s, along with the property market bubble. This is Hang Seng Index of Hong Kong. It increased by 828%. This is Jakarta Stock Exchange Index of Indonesia. It increased by 725%. This is not a benchmark index internationally. However, I just put it in this slide as a neighboring country. This is KOSPI of Korea. Korea has 2 main indexes, which are KOSPI and KOSDAQ. KOSPI increased by 266% over 30 years. Now, I put all 8 figures, we just look at it, into this slide to compare performance over 30 years of 8 index. As you can see, Nasdaq of US shows the best performance, Hang Seng of Hong Kong is the second best, and Japan is the worst performer, and Singapore is the next. I never expect this result anyway. This is an interesting comparison. However, you cannot see index increment or decrement only when you compare index to find which one is good and which one is not. This is a comparison of dividend yield of same indexes. You can see obviously from here that STI average dividend yield is the highest among those. It shows the unique character of Singapore stocks. In Korea in general, investors usually don't care too much about dividend in the history. However, I think in Singapore, dividends are one of the most important piece of the data for investors to determine what to invest. Singapore's stock price is in general much less fluctuate than other countries. There are many listed companies in Singapore that have a dividend yield of more than 5%, but it is very difficult to find this kind of yield from Korean companies. Since we are talking about STI in this clip, let's talk about pros and cons of STI. STI is definitely low volatile compared to index of other countries and pays out higher dividend yield obviously. However, as you saw the performance over the past 30 years, in terms of index growth itself, STI is not a good performer. And as I explained earlier, banking companies are the leading industry sector constituting the STI index, and followed by companies related to the shipbuilding and the real estate. This is not an innovative industry, but a traditional industry sector. So we cannot expect high growth like what would happen in Nasdaq. So by looking at the nature of industry sector constituting the STI, it is difficult to expect dramatic growth in the future, but it will have steady growth to follow market inflation. Now, do you think STI is still attractive? Then you can buy an STI ETF. My next video will talk about ETF, but in short, only 10% of active fund can beat the performance of market index, which means it is better to buy market rather than just end up with paying a lot of fees to fund house of active fund. That's why if you think STI is an attractive index to invest in, you may consider STI ETF. You can buy STI ETF from two fund management companies, both listed in SGX. SPDR STI ETF, managed by State Street, and Nikko Asset Management STI ETF, managed by Nikko Asset Management. In terms of chart, performance, and dividend, as these ETF trace STI, these are almost the same. However, unless they are twins, it's not possible to be 100% the same. There is some difference. SPDR can be slightly better in all aspects. Firstly, the fund size of SPDR is 3 times bigger than Nikko. Secondly, it has a little bit lower expense than Nikko. This is because their fund size is bigger, unit fixed cost is smaller, which is enabling lower expense to the client. And lastly, it has low tracking error. Tracking error means deviation between STI ETF chart and STI index itself. By right, STI ETF is supposed to follow the actual STI index 100%, but due to the time gaps, rollover, and whatsoever, it cannot be 100% complied. This chart shows you the actual dividend yield over the past 3 years. Dividend between two fund management companies SPDR and Nikko is the same, but only the payout period is different. Dividend yield for past 3 years is between 3.5% and 4.5% per year. Now, let me show you how to buy this ETF if you made up your mind to buy. There are many platforms in Singapore you can access ETF purchase. As I am familiar with the FSM, which is one of the popular platforms which offer competitive fee, I screen captured from FSM platform as you can see from the screen now. Minimum purchasing quantity is 10, which means if you have $27, you can start a transaction regardless of commission. This is the screen from the same platform. FSM for STI ETF by Nikko Asset Management. Basically, everything is the same and the minimum purchasing quantity is 10 as well. Alternatively, you can buy from Nikko Asset Management directly. This is a screenshot from its website. As you can see on the left, you can even sign up for an RSP, which is a regular saving plan. You can invest as little as $100 per month and invest continuously for a long term. So, $100 or any amount you wish to invest monthly, money will be withdrawn automatically from your bank account once you sign up. I hope now you can have an idea about STI and its ETF. Thanks for watching my video today again, and please leave a comment if you have any question.